Welcome to Money Mavericks and Mayhem, the podcast where finance meets audacity in a whirlwind of insight and excitement. Join hosts Adri, Bleier and Ryan Duchak as they bring you closer to the stories of risk takers, rule breakers, and boundary pushers who are reshaping the financial landscape. Perfect for seasoned investors, budding entrepreneurs, or anyone curious about the tumultuous world of money. This is Money Mavericks and Mayhem.
Back to Money Mavericks and Mayhem, where we dive into the twists and turns of financial history and its impact on our understanding of money. Today, I'm Adri Bleier.
And I'm Ryan Duchak. Today, we are diving deep into the life and teachings of Burton Malkiel, exploring the strategy of dollar cost averaging and examining a notorious stock market mishap known as the fat finger error. So let's get started, Adri.
Financial Maverick today.
I certainly can, Adri. So Burton Malkiel is perhaps best known for his seminal book, A Random Walk Down Wall Street, which was first published in 1973. In it, Malkiel champions the efficient market hypothesis, which posits that asset prices reflect all available information and thus consistently trading at a fair market value, making it impossible to systematically outperform the market.
Yeah, well, at the time, that was, a pretty revolutionary thought, especially coming at a time when active stock taking.
Oh, exactly. He argued against the predictability of stock movements through either technical analysis or insider knowledge, but instead he advocated for a buy and hold strategy using index funds which mirror the performance of the entire market or specific segments of it. His advice was aimed at reducing trading costs and fees while harnessing the market's overall upward trajectory over long periods of time.
Okay, so it sounds like he really democratized investing, really for the average person, I think.
Absolutely he did. And beyond just his writings, Malkiel has had a practical impact through his roles on the boards of major financial corporations and mutual funds, promoting the principles of broad market exposure and low-cost investing. His teachings encourage investors to focus on building a diversified portfolio tailored to their own risk tolerance and retirement timelines instead of trying to time the market. We hear all the time about people trying to time the market, and it is very rare that they do it accurately.
Yeah, for sure. Timing the market's always very difficult. I think we talked about that last show about, buying low, selling high, and how oftentimes it ends up the opposite because of human nature. And, you don't know when that top's going to be or that bottom's going to be. So, it can be difficult. So obviously, as we said, his approach ended up making investing more accessible and certainly less intimidating for the average investor. But with that, I'm sure there's also criticisms. So what are some of the criticisms he faced regarding his theories?
You're absolutely right. His ideas haven't been without controversy, and critics argued that efficient market hypothesis really underestimates the impact of human emotion on stock prices, and that active management can outperform index funds under certain conditions. But despite this, his principles have held up remarkably well in the long run, influencing countless investment strategies and retirement plans.
Yeah, it makes a lot of sense for the average investor, right, who may not have a real good handle on all the different stocks and all the different options to say, here's a passive index. It's a good way to get a fairly diversified portfolio and help keep the costs down and kind of buy and hold. And over time, you likely would do pretty well. But of course, yeah, if, there's certain times where active management could outperform that, but that's always hindsight. You don't know that you're going to outperform something till after that.
Yeah,
Uh,
I think one of my biggest arguments as his proponent is length of time. You might be able to outperform the market this year or next year or the following year. You might be able to do it all 3 years. But over the next 10 years, are you able to do it every single year? Possibly, but probability says no. With doing everything correctly and not using insider trading or anything like that, that is a very challenging proposition to do year in and year out over a long period of time. And
yeah,
I think that's what Malkiel really was endorsing.
yeah, for sure. I mean, it's active management. You're right. I mean, from a short period of time, maybe more opportunity, but as we lengthen that time, it just seems to add more risk, or potentially could add more risk to. Are things individually change at such a or can change at such a quick pace that are you able to keep up with that activity? Whereas passive management, if you're invested in the S&P 500, just for an example, hey, you have those 500 large cap companies that that's who you're kind of tracking, and it makes more sense. I shouldn't say it makes more sense. It's just a nice option for a lot of clients or investors out there that may not want to or have time to or have the interest of looking at these things. The majority of,
I think there's a time and place for both, is
yeah,
my answer. It really depends on the type of account, the specific goal of that type of account. If you're trying to trade on it and I don't want to say gamble, but almost seeing what you can do, that's one thing. Now, if you're 20 years old and you're looking at your retirement account and working 60 hours a week, well, you might not have the time to actively manage. And it's also type of investment related. What sector are you looking at? Specific industries, so on and so forth, inside of it, where a low cost index fund might make more sense than an actively managed fund.
yeah, hey, it all makes sense. His legacy certainly offers a lot, as we talked about, for both seasoned investors and newcomers to investment field to learn from. Speaking of foundational investment strategies, let's move on to one of the key tactics Malkiel endorsed, which was dollar cost averaging. So we'll talk about that when we come back.
Best Ever Granola is a woman-owned Pittsburgh-based company specializing in small-batch, gluten-free, and vegan granola. They rely on the power of simple ingredients: organic gluten-free rolled oats, pure PA maple syrup, organic unrefined cold-pressed coconut oil, and a variety of raw nuts and seeds. It is, well, the best ever. Find their original dark chocolate chia as well as seasonal offerings at over 90 retailers regionally. Best Ever Granola is not affiliated with LPL Financial or the Monteverdi Group.
So Ryan, can you explain the mechanics behind dollar cost averaging?
Yeah, it's pretty simple. In thought, dollar cost averaging involves regularly investing a specific, like, fixed amount of money into a particular asset or portfolio, regardless of the share price. And by doing so consistently over time, you will reduce the impact of volatility on your overall investment. Instead of me investing, let's say, $1,000 into something today, doing $100 per month over the next 10 months, I invest the same $1,000, but my price impact or volatility impact based on what the price of that investment is today gets reduced over time, or the volatility of that gets reduced if I'm buying in $100 increments instead of one $1,000 purchase. Does that make sense?
Yeah, that does make sense. So you're talking about really consistency, right? So we're talking about, let's say, to your example of once a month, I'm going to put the $100 into this ETF or whatever. So I'm going to every month consistently, I'm going to buy new shares of whatever that investment is. So some of them are going to be higher. Some of them are going to be lower cost because of the fluctuation in the value of those shares. And then we're doing that over it's a longer game. Dollar cost averaging isn't something that you're going to try to do over a 6-month period, right? I mean, you could, and then look to sell, but you would really do this over a long period of time. It seems like that would be more beneficial. So how does this strategy, from if you look at this from market conditions, people say, well, the market's dropping, maybe I don't want to buy, right? People get scared when the market starts to drop and they end up pulling out. Or if the market's climbing, they're thinking, well, should I sell? Or, so how does this work in different market conditions?
Well, it's about average cost is what it boils down. In fluctuating market, dollar cost average, that's where it's the most powerful. When prices are low, your fixed investment buys more shares. And when the prices are high, you're going to buy fewer. So over time, this can lead to purchasing shares at a lower average cost, smoothing out that risk of market fluctuations. So as an example, let's say prices are low today, and I'm sticking to that $100 example, and let's just say it's $100 per share. So today I buy one share, and then next month prices go down. So now it got cut in half, and now it's $50 a share. So my same $100 next month buys me 2 shares. So now I've put in $200 and I own 300 shares, or excuse me, 3 shares for that. So my average cost is, what is that, 0.667 average price. Instead of, if I put all that $1,000 in on day one, I paid $100 per share. Now, some people might argue, well, why not wait until it's $50 a share and buy the all $1,000 at that point? Well, that requires a crystal ball and knowing when prices are going to be at their lowest. If we knew that, dollar cost averaging would not be a good thing.
Right.
Since we don't, dollar cost averaging can help lower that average cost. Does that make sense?
Makes a lot of sense. And I again, from a probably, I don't want to say all investors, but about many investors who just don't have the time interest, it's a really good strategy for them to get used to. I think a lot of people, using your $1,000 example, you get $1,000, you say, I'm going to invest this $1,000. Well, I better get it into the market right away, because what if I lose out? And again, if you're playing a short game, that's a whole different conversation. But if you're in your 20s or 30s or whatever, and you're looking for retirement, or you're investing for the long term, and instead of dumping that all into that one purchase all at once, systemically, that dollar cost averaging seems to have, you can't say across the board that one's always going to outperform the other, but over time it seems to give you a better result, right? Typically because of market fluctuations, as we discussed. So again, it's a really good way to manage that risk associated with volatile markets. Are there specific situations where dollar cost averaging might not be the best approach for an investor?
Yeah, so there are some scenarios where it might not be optimal. For example, if you've got a large sum of money to invest in the market steadily rising, investing a lump sum early on might yield better returns than spreading out that investment. Strategy requires much more market insight in a much higher degree of risk, especially if market conditions change unexpectedly. And that's why I'm a proponent for dollar cost averaging, because we don't know. The market could be steadily rising, but it could be hitting its peak today. So we don't know. It might keep going. And in that case, I should buy all today. But if it drops, then I should dollar cost average. There are scenarios where it's not beneficial, but the best way to find that out is hindsight. So it's a hard thing to say. It might work, it might not work, but because of market fluctuations and all of the information out there in markets and not having that crystal ball, I personally think that dollar cost averaging makes more sense for a long-term investment.
Yeah, that does make sense. Unless there's a situation, and it's always hard to say up front, but if there's maybe a temporary situation that would to cause the markets to drop temporarily. Like, I think about that, during COVID, there was a month or two where the market really dropped because everybody kind of panicked, didn't know what was going on for very good reason. But you didn't know for sure, but you probably had a pretty good idea that was going to come back relatively quickly. So in those little circumstances, maybe it's if you have the cash, buy in when we have this real drop, but that's very rare that we have a scenario that you can kind of pinpoint and say, okay, this is just kind of a flash crash. And if your ability to get in there, that might be a reason not to dollar cost average at that point. But I think for general circumstances, it does make a lot of sense. And I'm a proponent to it, just like you said you are. Because at the end of the day, it's balancing out that approach, right? As we talked, especially for people who may not be as invested in the stock market from a time or knowledge standpoint, or for people that are more risk adverse, right? I think it's a really, really good strategy for them. So if somebody's out there listening to this and saying, well, I hear what you're saying, Ryan, and I don't really know how should somebody decide if dollar cost averaging is right for them or not, for that matter.
Well, investors should consider their financial goals, their risk tolerance, and their investment timeline. Dollar cost averaging is excellent for those who prefer more of what I'll call a set it and forget it strategy, which that can be less stressful, less time consuming than trying to time the market. It's also a fit for those who are investing regular earnings. Like if you're diverting a portion of your paycheck into a retirement account, it's just that steady, consistent, and whether it's into a retirement account or you have an excess in your budget every month and want to invest that excess money. That's dollar cost averaging. Now, you should always keep in mind investing involves risk, including the loss of principal. No investment strategy can guarantee a profit or protect against loss. So dollar cost averaging involves continuous investment in securities regardless of fluctuation in the price levels of those securities. So an investor should consider their ability to continue to purchase throughout fluctuating price levels. My example earlier was kind of good, where if you're going to do it at the $100 per share price, but then when it gets cut in half to $50 within a month, if you're going to say, no, I don't want to buy that same investment, now you're not dollar cost averaging. So you have to stick to the plan when you're going through this strategy.
Right. That makes sense. And we're really just talking about mathematical averages and saying, okay, well, there is no guarantee that any of these stocks are going to go up. So you could buy it today and say, okay, I'm going to dollar cost average. And you could certainly dollar cost average an investment down to zero. Technically, you could do that. So to your point, there's no guarantee. But just as if you do your research, timing doesn't work. It works sometimes, but it's more luck than anything. And if we're just going to invest, then let's do this dollar cost averaging again. Probably makes a lot of sense for a lot of investors.
Yeah, it boils down to risk management. Is today the lowest price that this stock is going to be? Maybe
Right.
not. We don't know. So if we want to reduce the risk of that possibility, we dollar cost average in, and then we get an average price. It might keep going up. It might start going down and fluctuate up and down over time. We don't know, but by dollar cost averaging, you reduce that risk that it is the highest point.
That makes sense. So we do, if people are listening, they're saying, okay, I kind of understand the idea of dollar cost averaging. Somebody might be thinking, well, is that just a singular stock that I can do that in? Can I do that in a mutual fund? I've heard of these things called ETFs. I'm not sure what that is. Can I use dollar cost averaging for those type of investments? Are these all open? For listeners out there, can they dollar cost average into just about any stock investment, or they're only limited to certain things like a singular stock, for example?
Yes, and yes, and I think yes. So where you're limited is more in complex products. So if you're doing some private placements or more stocks, you can do it. Mutual funds, you can do it. ETFs, you can do it. Bonds individual bonds would be hard to do. You have to find the availability. You're somewhat limited there, but there's not as much price fluctuation traditionally in bonds. But you could do it in a bond ETF or a bond mutual fund. So the majority of investments, the answer is yes. As with everything in life, nothing is black and white. There are some circumstances where you cannot, more because a fund is closing to new investment. So, or additional investment, then you wouldn't be permitted to, things like that. But as a general rule of thumb, I would say yes, you can do it in pretty much any investment.
Okay, good. Well, I think that thank you for that oversight, Ryan. I think that really breaks down and helps to clarify how dollar cost averaging can really be a cornerstone of a smart investing strategy for a lot of folks. So now let's take a break, but we'll explore a rather dramatic event in the financial world known as the fat finger error, where a really simple mistake had huge repercussions. So we'll talk about that when we get back. Struggling to wake up refreshed to tackle your busy day? Introduce Nolapelli to your bedtime routine. Their innovative bedding and sleep masks work in sync with your body for a deeper, more restorative sleep. Made right here in the USA from advanced performance fabrics, Nolapelli products balance moisture and regulate temperature so you wake up looking and feeling ready to conquer whatever the day throws at you. Invest in better sleep and better mornings with Nolapelli. Use code MONEY15 for 15% off your first purchase, because the path to success starts with waking up on the right side of the bed. Nolapelli is not affiliated with LPL Financial or the Monteverdi Group.
Let's jump into the fat finger error, Adri. While it might sound comical, it has led to some serious financial fallout. So can you walk us through what a fat finger error entails in some notable instances?
Sure, yeah. So a fat finger error, and people probably heard of this. You fat fingered it occurs when trader makes a mistake just inputting the trade details, right? Hitting the wrong key or entering, typing in a number and putting the decimal point in the wrong spot, things like that. But these mistakes can cause huge, of course, unintended, nonetheless, massive mistakes in trades.
So if I were entering a trade for 100 shares and I fat fingered that to hit 1,000 shares, is that kind of what
That's pretty much
you're saying?
exactly what we're talking about. Yeah.
Okay. What are some of the most memorable fat finger errors that you can
I
come
remember
up
one
with?
lad. That was a bad one. No, I'm kidding. Ryan would never do that.
Have to play
Right.
Ryan makes sure to triple check his trade numbers because he doesn't want to pay for that error.
Yes, they can be costly, and yeah, triple check, quadruple check if you need to. So probably one of the most infamous fat finger errors occurred in 2014 when a trader at a major institution mistakenly placed an order worth billions instead of
B?
millions. And a lot of people don't, when you hear millions, because today we've been so desensitized to money because you're talking about trillions with debt and people it's hard to get your head wrapped around the difference between a million and a billion. It's a staggering amount, or even a billion to a trillion is even more so, but it's a huge difference. But people throw around the word billions like it's nothing. So billions instead of millions, which triggered unexpected market volatility and led to a temporary plunge in values across multiple markets. And it was quickly corrected, not before causing a major stir among investors and prompting a review of trading systems and again regulations and safeguards from these kind of thing happening. Because if you make these kind of mistakes, we talked about market makers. I don't know, a couple episodes ago, I don't know, but all of a sudden, you could change the direction of a market if have these huge sums of money being bought in a certain sector or whatever. I mean, you could change the sentiment very quickly. And when you're going from, okay, I'm going to trade a couple $1 million into this, which is big numbers, to whoops, that was a couple billion. People see that trade. My God, what's happening? And you could affect the markets up or down for that matter, depending on what you're looking, what happened. But the errors can be very costly.
Yeah, that's the snowball impact of that is something I hadn't considered. Like I'm hearing it just costs that trading firm $1 billion instead of $1 million to buy a stock or sell it. I don't know which side they were on, but regardless, as we've mentioned in the past of supply and demand, if there's a demand for $1 billion worth of a company that's supposed to be $1 million, people are going to like that. That matters. That's going to move the price of that stock, which that snowballs to the why, the who knows something that I don't know amongst the traders. And that could kind of create a panic or a buying frenzy on either side, which I mean, I guess errors like this kind of highlight the risks inherent in digital trading platforms. Entering it on your computer instead of, I mean, it's very hard back when you used to call in to place a trade to accidentally say billion when you meant to say million. That's a challenge. Adding an extra zero or two to a trade when you're typing it into a computer. I mean, I don't want to make it seem like that's easy, but it's much easier than mistaking billion for million.
Yeah.
When you're
you
calling
think
it in.
about it, if you're not in a position like we're in, and let's say you're trading yourself, right on it, you're doing your own buying and selling, and you're on a platform. I mean, there's plenty of times where I'm typing a letter or something and you misspell, or you just hit the wrong keys, or you're putting a phone number in and you hit the wrong, number, or add an extra one and you'll go back, that doesn't look right. But those things are, when we're doing our job, again, to your point, triple checking, quadruple checking, just to make sure it's all right. But if you're not that due diligent and you just say, okay, yep, going in, I've got 1,000 trades to put on for these, to enter for these big investment firms, and you're just data entry, boom, 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 I could see people missing it. I mean, the difference, I think that obviously is not a common, where you're talking about millions to billions,
No.
but, and those are things that could very well move the market. But most of the time, it's probably 1,000 to 10,000, where it's not going to, those things aren't going to, have a lasting effect on the market. But client's not going to be real happy about it. We're not going to be real happy about it. So, you don't hear about these things driving markets too often, but they probably happen fairly often.
Well, and they can happen. Now,
Sure.
me as an example, the majority of the time when I'm entering trades, I am on the phone at that moment with the client. It's incredibly rare that I'm not entering it while speaking with them. If I'm not in front of my computer, I might be calling you or calling one of our other partners to place it, but 90% of the time I'm speaking with the client who's still talking about other things while I'm entering that trade. And if I'm not triple checking that and paying attention to the confirms to ensure that it was 100 shares instead of 1,000, I have fat fingered prior to, and then I review and say, oops, I almost bought you 1,000 shares instead of 100.
Right.
So I know what we have on our side, but what measures have been implemented to prevent these kind of mistakes on the, I guess, global level?
They just fired all the people that do that. Well, I was thinking, before I get into that, I was thinking also, and it's never happened to me, and I don't know if it's ever happened to you, but I can imagine if you're on the phone with a client and the client's talking and they're excited about something, you go, oh, yeah, buy 100,000, and you go, okay, 100,000, you're putting in, okay, he said to put 100, you say 100, yeah, 100,000, enter, whatever. Oh, wait, Ryan, I meant 1,000. I didn't mean 100,000. I mean, again, and that hasn't happened to me, but I could see that happening out in the world for sure.
Yeah, that I can't say that's happened to me either, but I could easily see that happening.
Yeah.
Of you're thinking about multiple things, you're making a decision on the fly. I mean, the typical process is either we're calling a client to recommend a transaction, or they're calling us to discuss it, and they're thinking through that, and they might be thinking, well, I've got 100,000 available to invest, so I would want to do about 1,000. Okay, put 100,000 on that. Oops.
Right.
And if we don't question that or confirm that could get you in some hot water.
Yeah. Again, it's never happened to me, or I'm not familiar with it in our firm if that's ever happened. I mean, the firm's been around for a long time, but I could just as you were saying that, I was like, I'm sure that has happened.
I'm sure someplace, sometime.
Yeah, for sure. But to answer your question, in response to and we're talking about those high profile mistakes, trades. There might be multiple verification steps, like today you have two-step authentication for everything you sign into. So making sure that, hey, before this trade goes in, depending on your relationship with that client and your agreements with that client, maybe they need to sign off on the trade before it even gets processed, right? Things like that. What else? I mean, fail safes that can catch unusual orders. I mean, we've talked about the circuit breakers, right? So that's more market wide, but where and I think this will probably get better and better with AI. Like, look, just keeping a track of trading history, and okay, you normally, trade 1,000 stocks, $1,000 per year, let's say, back to your dollar cost averaging, and all of a sudden now there's $100,000. Like, whoops, let's put a red flag up, right? Let's make sure this doesn't go through till we really verify that. So that can help catch unusual orders. Additionally, training, right? It's always good for traders. That's been ramped up for a lot of firms, just to help reduce the likelihood of these kind of inevitable errors, but silly errors from happening. We talk about human error to an extent, and people were okay. Hey, we're humans, we made a mistake. But not when you're talking about people's money. They're not usually very lenient at that point, which I get.
To me, it's fascinating to look at how a simple human error can ripple through the financial system. And it underscores the importance of having those robust systems and, as you mentioned, that thorough training in the fast-paced world of stock. I mean, there's times to be fast and there's times to have attention to detail. When I'm doing my hair in the morning, I can be fast. If there's a hair out of place, not a huge deal. I can get past that. When I'm entering a trade, I need to be slow, make sure I'm doing it correctly and appropriately in the way it's supposed to be, not just ripping through that because the consequences can be big personally and throughout the market. Like for me, for the client, or for the rest of the market, that ripple effect can be big.
Yeah, exactly. You're absolutely right. Keeping yourself in a position where you're not, in a place where you're being distracted. You're sitting down and doing that in a nice, quiet environment where that's what you're focused on. You're not thinking about everything else. And sometimes you have to talk to the clients, be like, hold up. I know you have this whole story you want to tell me. I want to hear it, but let's focus. Let's just stop for a second. Let's make sure we get this part done. And you can tell me all about your trip to
I can't tell you how many times I have said, I'm sorry, I wasn't listening. I was focusing to make sure I entered that trade correctly while we were talking. Could you repeat what you just said? And it's like, I'm not trying to be rude by not listening to my client while they're talking about what happened with their dog that day, but and then we can get to that.
We could talk. Yeah,
that story.
Absolutely, we could talk afterwards. Let's just get this done first and move on. So that's a nice safeguard people should put into place. But I think that today's episode, although on the shorter side, but I think we covered a lot of ground and given our listeners a lot to think about, from Malkiel's influential theories. I'm never going to get the name right, so. And the benefits of dollar cost averaging, which we got into. Again, it's not terribly complex, the dollar cost averaging, but it's just good for people to know. Here's a nice mathematical way to go about investing. And then, of course, the dramatic impact of fat finger errors. It's just good to know. People don't do these things. This isn't one of the mayhem stories that was intentional, or anything like that. Mistakes do happen, but we just need to make sure that we're taking the time and make sure that, if you're dealing with somebody or if you're doing it yourself and you're putting your own trades in, if you're out there as an investor and you're doing this, just make sure you're in a position where the dogs aren't barking and the kids aren't yelling and, so it's dinner time and all this is going on. Nice, safe, quiet place to really just focus. Make sure you get, it's not all day, right? It's going to take a few minutes. Just focus in on that. So I think that's important. And at the end of the day, these, all these stories just show the breadth of topics that investors and financial professionals, everything that we have to consider on a day-to-day basis. We're doing our work, and things that investors should know about and think about when they're either looking to invest themselves or looking to hire a financial advisor of some sort for their own personal or business. Just keep in mind there's a lot to it, and just finding the right people to trust.
Absolutely. And hey, I see it as a breath of fresh air to have our mayhem feature as people who are good-hearted and trying to do a good thing and made an error.
Right.
I prefer that to the people swindling people and purposely creating frenzies based on fraudulent information to make themselves rich. This type of mistake still happens and is still something to know and be cognizant of. But it's not just the snakes that you need to watch out for. It's the simple things too. And we need to pay attention with everything we do, because money matters, and the implications, whether you have a good intention or not, the implications can be far-reaching. So thank you, Adri, for the insightful discussions as always, and thank you to our listeners for joining us on Money Mavericks and Mayhem. And we hope you found this episode enlightening, and look forward to bringing more exciting and educational stories from the world of finance.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risks including possible loss of principal. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.